The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to this Next Gen Personal Finance webinar on what's trending in personal finance in 2016. My name is Tim Ranzetta and I'm the founder of Next Gen Personal Finance. Thanks for tuning in today. I am going to try and complete the impossible, which is to give you really a good flavor of what's happening in about 7 or 8 different major topic areas within the world of personal finance. It actually was a lot of fun going through the process of building this presentation deck out, because what it required me to do was to go back through our blog. Those of you not familiar with our blog, we typically try and put 2 posts out there every day, really focused on current events. And it was fun to go through because it really highlighted to me the many changes that are taking place almost on a daily basis in so many areas within personal finance, which I think makes it such a challenging topic. So I wanted to get started, however, by first asking a question. And so our first polling question, I'm going to go ahead and send that out, is really getting a sense of how you feel, how satisfied you are today with how your curriculum integrates current events. And I guess it could also be current trends. So I just sent that one out there. If you can take a minute to respond. All right, I'll give you about 5 more seconds. I realize some of you are probably on the phone, so not able to respond to this question, but we're getting a really good response rate. So let me close it and send out the results. So it's about 50-50, which I would have assumed that many of you on this call are not satisfied with current events, but it looks like 44% of you are, and perhaps just wanting to get more up to date on what current trends have been. So thank you for responding to that. All right, I'm going to actually go into a second polling question. This is going to be helpful to me because I've got about 60 slides in 60 minutes, which means I know I talk fast. I'm from New Jersey, but even that may be a challenge. So hopefully this question will help me. I'm sorry, let me try a new poll here. And so here I'm trying to get a handle on what unit, easy for me to say, that you teach that you think requires the most updating. So take a minute to take a look at that. Again, I'm trying to get a handle on where I should be focusing time for this presentation. If you tell me where you think the most updating in your lessons is going to take place. All right, about 5 more seconds. And I made this a little more challenging for you by only letting you pick one, because I know many of you probably would have selected many. So another 5 seconds, 4, 3, 2, 1. Let's share the results. And it looks like investing and paying for college are 1 and 2, but a lot of categories are getting responses. So this will help me calibrate a little bit. And actually, as I think about the slide deck itself, I think I probably have the most slides, the most content dedicated to both investing and paying for college. So let me hide those results and we will move on. All of you should have received via email a copy of this deck. I thought some of you might want to take notes as you go, or just took some time. It looked like some of you may have taken some time prior to the webinar to go through it. So here is my very ambitious agenda. I guess there are 2 broad themes that come through, and that is times they are changing and technology is really having a dramatic effect on financial services as well as the world of work, and you'll see that come through. Secondly, in terms of the structure of what you're going to hear, I'm really trying to serve dual purposes here. One is what's the trend? And then the second part is, okay, big deal. Now, what tools can you bring in the classroom to teach the trend? And so each section, I'll go over a topic, I'll talk about what trends I'm seeing, and then provide you with some tools. Third, because there is so much material in here, I'm really hoping that you're going to use this as a reference guide throughout the year. And so when you find topics that you want to dive into, I've basically provided links throughout this document to source documents. So if you want to go deeper into research, you want to look for additional information, hopefully that'll be handy. Because again, there is a lot of information we're trying to go through here. So here are the topics we're going to cover. Bank accounts, cross-selling, which has kind of been a real hot button topic recently with a large national bank in the news. We're going to talk about paying for college, credit scores, investing, identity theft, careers, how teens shop, fintech and the pace of innovation, and then looking forward to 2017, what we might expect. So again, we are, NGPF is one team. We've tried to highlight what we think the largest trends are. If there are additional trends you feel like we missed, please let us know. Things that are on your radar screen and you're wondering about a project or activity that you would like to create around that, please let us know. So I thought it would be good in terms of just anchoring a little bit here to take a look at, this was a survey done by Bank of America. And let's take a look. They basically asked folks, young Americans, what they wish they had learned more about in school. And number 3 items, investing, taxes, how to manage monthly bills, and probably with that comes managing an account. But I thought this was a good way to kind of ground us. This was asked of thousands of folks looking back and having experienced the real world, what they wish they had learned. But this is interesting to us because we actually go through this to ensure that we're providing projects, activities, and lessons to cover all of the things. Now, I cannot tell you, and my wife and kids can probably attest to this, the how to cook part, not so good at. Okay, so let's look at bank accounts. This may surprise a lot of people, and that is the high number of millennials who are still writing checks. I know this is probably top of mind when I give workshops throughout the country. I'll often hear from educators, a question on their mind is, should I still be teaching how to write a check? And the data suggests that about 42% of millennials are still writing them. And so for me, it's always an and. You should teach bank accounts or writing checks and how to manage online accounts also. But I thought that was interesting. The other data showed this kind of conflict between old and new with millennials. So the question that was asked here in a study called the 2016 Millennial Money Mindset Report, that's a lot of M's, they asked, when shopping for financial products or a relationship with a financial institution, which of the following factors are important to you? Interestingly enough, the number 1 item on the list is branch locations. And the number 2 item is online banking tools. So there is this kind of yin and yang, push and pull with these millennials in that there seems to be something about a physical location that gives them comfort and security. And thinking about that, because when you actually analyze and compare online banks versus branch banks, almost across the board, online banks tend to have lower fees in checking accounts, higher interest when it comes to savings accounts. And yet they're still relatively a niche market. And I think it's probably due to this fact. People still want to see the bank where their money is located. When we think about fees, the 2 largest fees when it comes to checking accounts are monthly fees as well as overdraft. Those are relatively stable, at least over the last 2 years, according to studies by Wallet Hub. You still see overdraft fees at around $32 on average, and monthly fees at about a little less than $8. Now, obviously, student accounts typically are fee free when it comes to that monthly fee. However, once those students are out of school, they tend to go, unless they have balances above a certain limit, they will continue to pay a monthly fee also. Now, one of the things I'm big on, I alluded to it earlier, is the importance of teaching students how to manage online accounts. And I think this figure in and of itself shows why it's so important to manage accounts. And in this case, I think account alerts can be very helpful. And so basically over the last year, according to a report from the Consumer Financial Protection Board, the 628 biggest banks made over 11 billion, that's with a B, from overdraft and non-sufficient funds fees. Now, I was really heartened recently. I was in Rhode Island on Saturday for a great conference, a great workshop put together by Pat Page and Dr. Margaret Brooks. And they had a student panel who was asked the question how they use technology today. And I was heartened to hear many of them indicating they had set up alerts, including one woman in particular who mentioned that she had alerts anytime there was any money moving in and out of her account. She had an alert set. And so she would know where her money was going, but also she'd be able to capture any activity that she was not responsible for. She'd have kind of an early warning system there. So I think that's incredibly important. So those were the trends. As I alluded to earlier, the importance of managing an online account is an activity we have, which is probably one of our most popular, in that it takes students through a series of transactions and just gives them experience in understanding how to manage an online account. There's also an interactive that we have. And again, all of these link to the specific NGPF resource. But basic banking activities, we often take things for granted that students will know how to use an ATM machine or a debit card. And that's really what this interactive deals with, is some of the basics of, again, managing an online account. We also created a mini activity about alerts. What alerts should I set up on my checking account? Again, it's easy to tell folks to put alerts in, but I always strong believer we actually have to show them and give them practice and let them go ahead and do it. Our most popular webinar, which I've provided a link here, is around this issue of how to update your checking account unit. And so that's a webinar. If you just want kind of the cliff notes, if you click on the webinar, you'll see that we provide the resources that are incorporated there, the activities, the simulations, as well as the other activities established so that activity ideas to help bring your checking account unit to the 21st century. So that's the world of banking and checking. Now, I decided to focus on cross-selling as kind of a standalone section because I think that's an incredibly important concept for students to understand, and it really gets at the issue of incentive. So the most recurrent cross-selling opportunity you'll see is when you walk into a fast food restaurant and they've actually bundled a lot of their meal plans together now, but it's the McDonald's example of, do you want fries with that? So you're already buying something from us. Would you like to buy something else? And you see in the second image here, the importance of cross-selling. You've got a customer, and if you can upsell them or if you can sell them another item, they're that much more profitable. And there are books written about this specific to the banking industry. This book about relationship banking, cross-selling the bank's products and services to meet your customers' every financial need. Now, many of you are familiar with the issue of fake accounts that were established at one large national bank that came about really I think most would agree it came about because of very aggressive quotas that salespeople or people on the floor of the bank were expected to hit. And those quotas were based on the number of new products that they could sell to existing customers. And I think it's important. Now, the reason I think this is such a great teaching moment is it helps folks understand that the person you're sitting across from who's you're talking to about a financial product may have other incentives in pushing a specific product. And so we've created a lot of teaching tools around this. We have a question of the day. Why do incentives matter when it comes to financial services? We have a role play where students have them work through a role play of what it looks like, what it feels like to open a savings account. And I've provided some class notes. I think this is one of the most powerful activities that I've seen in the class I teach at, because I had a student, and you'll see this in the class notes. I had a student, basically in this role play, we have a bank representative discuss overdraft protection, which, as we showed earlier, is quite a large profit center for banks. And we have the bank representative push that pretty hard. And finally, in one of my classes, I had a student say, I need to read the paperwork. Let me get back to you. And I thought that was such an empowering, tactic for them to employ, and just feeling comfortable that anytime they're having a conversation with an adult and they're feeling intimidated, their spider senses are tingling, a great escape clause is, I need some additional time to review the paperwork. I'm not ready to make a decision now. And then the last piece that I included was this issue of workplace ethics, because there were some examples of whistleblowers in this recent account opening scandal that hit. And I think there's a great a short podcast where they actually talk to some of the employees, where they talk about the pressure that they feel to hit these quotas, and which led them to basically create these fictitious accounts, both credit card accounts as well as bank accounts. So they would open the account, perhaps transfer a little bit of money into that account from the customer's account, and then close it the next day so that they would get credit. Or they just figured out how to game the system. Many of them saw this, were upset about it, raised some issues. And I think it's good from a broader perspective of having a rich classroom discussion about what do you do when you see things happening that you're not comfortable in your workplace. And so that's cross-selling. Paying for college, I would summarize the key trends here. If you look at the data, the value of a college education is still evident. And obviously there's a lot of caveats there in terms of what you decide to study, where you decide to go to school. But if you look kind of at a macro level at the pay data, it's hard to argue against the value of a college education. Now, you obviously have to take into account too what the cost of that education is and how much student loans you're going to need to take on. So those continue to rise. And then finally, on the regulatory front, there's some new FAFSA rules I wanted to share with you. So here's a chart. On the left-hand side, you'll see earnings. On the right-hand side, you'll see the unemployment rate. And it's basically set based on the level of educational attainment. So I actually have an activity where I have students actually do the calculation about, what is the differential between somebody with a college degree, in this case, it's a bachelor's degree. What's the differential between a bachelor's degree and a high school diploma? And obviously the numbers here are done on a weekly basis. They've got to annualize it, and then they've got to think about the length of a career in terms of what the difference is. And then I have them actually look at some college, no degree. And you see there, the difference is about, what is that, $60. $60 per month differential. So about less than $60 a week. So a couple $1,000s a year differential, but you don't get much of a kick going to college. You don't get much of a kick in terms of, or a bump up in wages, because I also want to cement in students' minds that it's not going to college, it's completion where you really see the benefits of it. Because what's interesting is when you really get in the weeds when it comes to student loan data, you find those students who have the most trouble paying back are those that attended college but didn't finish. And their loan balances actually are not particularly high. They might be $5,000 or $10,000, but they haven't been able to get the wage increase to help sustain the ability for them to pay back on those loans. So on student debt levels, this is a noisy chart. I won't go into a ton of detail here. I think the thing that's alarming is two things. One is the bars continue to rise. And actually, this is as of 2014. I know we're over $1.3 trillion now. But then each of the bars indicates ages. And so you see the under 30 set of borrowers actually is about a third. And so people are paying off their student loans further and further into their 30s, 40s, and 50s, which actually are displacing other spending, whether that's getting into a home. There's a belief that student debt levels being as high as they are have really slowed down the housing market. So I would kind of just emphasize those points when it comes to student debt. I would also emphasize, for those who are wondering, should I be teaching this in the classroom? For me, this is the money slide. And I titled it, Can I Have a Do-Over, for a reason. And that is, when you ask students who've graduated from college, who've started to repay their loans, the question was asked, and this is excellent research out of George Washington, Anna Maria Lusardi's group. But the question was asked, before you got your most recent monthly student loan, did you try and figure out how much your monthly payments would be? So over half have no concept of what their monthly payment's going to be based on their last student loan. And then this figure 4 asks, if you could go through the process of taking out loans to pay for your education all over again, would you take the same actions or make a change? 53% would make a change. So actually I had somebody on a podcast. I haven't published that podcast, but it was somebody in their late 20s, I believe, with tens of thousands of dollars of student debt. And I really pushed them on that question. How could someone have had a conversation, or what would you have needed to do in order to make a different decision? And his point was basically what you see in figure 3, which is, if I had known my student loan payment would be 60 or 70% of what my take-home pay is, that probably would have been a disincentive. Now, having said that, there are efforts being made on the loan repayment side, and many folks are not aware of the fact that there are income-based repayments to keep your monthly payment to a reasonable level of your disposable income. However, know that it just means it's going to take you longer to repay that loan, and you may be paying more in interest. So that's kind of point number 1. Point number 2 is, I don't think students really have a good idea of what it's going to take to pay for college. And this comes from the survey you see on the right-hand side here from Junior Achievement, where basically the number I focused here on was that 11% of teens in the survey anticipate taking out student loans. And then just below it, I got the most recent study from the Project on Student Debt from the folks at TICAS. And what they found is the average student debt's about $30,000 for 2015 graduates, and 68%, so almost 7 in 10, had student debt. So there's a huge disconnect here. 11% think they're going to have to take out student loans when almost 70% do. And I'm afraid because they don't think they're going to take out student loans, they're not doing any of the work required to figure out how they're going to pay for college. Here's some quick FAFSA changes I wanted to run by you. Many of you have already experienced this. I would point you to a number here. 44% of high school graduates filed the FAFSA in 2014. Pretty disturbing, since FAFSA, the free application for federal student aid, is in many cases, almost all cases, the only way to access student aid. So major changes in 2016. The FAFSA was available earlier this year, October 1st of this past year instead of January 1st, as it had been in previous years. So it was moved up 3 months. And then the other big change is the tax return information that gets loaded into FAFSA. Now it's called previous year. So just a quick example, seniors in your class today, in your high school class, who are going to start attending school in 2017, September or August of 2017, their families would be using their 2015 tax information. Now, I guess the key in my mind is it's great that folks are getting ahead of the curve. They'll have additional time to be made aware of the need to file the FAFSA. And it'll be interesting to see in this first iteration whether schools will adjust the timing of their award letters. So it's not as it is for most schools, April 1st, you get your 8 award letter, and May 1st, you're making a decision. I also know many state universities in the state of California push that till the end of April, or even, really make that time frame short between the 8 award letter, understanding how you're going to pay for college, and the ultimate decision of attending a specific university. So that's changes to FAFSA. So got a long list of teaching tools here. In the interest of time, I won't go through all of them. I would point you to a new product we have called the Fine Print, and that's going to give your students practice. Before those aid award letters come through, we give them 2 to compare, and then a series of multiple choice questions for them to answer. Now, I should make clear, one of those 2 is an incredibly difficult aid award letter to read, and some may ask, well, I don't know how they're ever going to understand this. I don't know how, this seems really complex, but unfortunately, too often that's the case of the actual aid award letters that they're going to get. Now, while there's been a push towards more standardization, more plain English, more easier to read aid award packages, unfortunately, we're not there yet. So there's the activities and the tools that are available to help. And obviously, we have lessons on the specific. We have an entire unit dedicated to paying for college too. Okay, moving along here, and I'm going to pick up the pace a little bit. Credit scores. So 3 main points here. Because millennials are not using credit cards to the degree that other generations had, there's a large number of them who are credit invisibles. There's more data out there. So if you want to provide incentive for folks to take a look at their credit score, you can really get a good idea as to what the cost of having low credit is. And then lastly, and I guess this is more tied to the first point, because there are so many credit invisibles, obviously financial service firms don't feel comfortable lending to folks with very thin or non-existent credit files. So there's a lot of activity going on about finding alternatives to credit scores. So I mentioned earlier, this astounds me that this data is suggesting among 18 to 29-year-olds, 63% do not have a credit card. It's the lowest level for Americans under 35 years old since the Fed started collecting data. Now, obviously, from 18 to 21, extremely difficult for them to get credit cards because of the Card Act, which passed in 2009. And for folks under the age of 21, you need a parent cosigner, or you need to be able to prove you have the income on an individual basis to repay your credit card. So I think that's probably one factor. I think the other factor is once you attend college and get in the habit of living without credit, you're able to do it. And I think the third factor I would highlight is many of these students or many of these millennials saw kind of what the downside of having too much, of being overexposed on the credit side, having too much debt, what happened during the Great Recession. I think that probably left quite an impression. So how are millennials paying for stuff and actually we break it down even finer to look at 18 to 24-year-olds. This is a great report out of the Federal Reserve Bank of San Francisco. And what we're looking at here is the number of transactions by type. So I'm just going to focus on 18 to 24-year-olds. You're going to see about a third are paying with cash. Again, this is not the value of transactions. This is the number of transactions. So about 3% paying by check, 3% of transactions are by check. And then the ratio between debit and credit is about 3-1. So they're using their debit card about 3 times more frequently than their credit card. And then you have electronic and other on the top. So you see, again, verified again, the lack of, or the preferred use of the debit card versus the credit card. Here's just some confirmation about the invisibility of these individuals. Now, some may ask, well, why would an 18 or 19-year-old want to borrow anyway? And that's probably not a great age for them to be buying a new car, which I would think would be one of the that would probably be their first type of loan other than a credit card. A car loan would probably be the second item they would be looking to borrow for. Obviously, student loans, at least federal student loans, do not require a credit check. So many of those 18 and 19-year-olds have debt, but are not being scored or not being evaluated by the creditor. So what this shows, obviously, is even in the 20 to 24 age group, almost 40% are credit invisible. And so that means they either have never borrowed and don't have a credit file that exists, or do not have the darker part of the bar. So it shows that there's just not enough data for them to be scored. Cost of low credit scores. This is, we actually have an activity created which helps students actually calculate what the cost of a low credit score is. And so this is great data. It actually shows you by FICO score what you can expect to pay on a home mortgage. And there's similar data available for car loans too, which probably would be more engaging for your students. But you can quickly see, if you combine this table with a calculator, you can quickly determine what the cost of having a credit score over 760 would be compared to under or in the 620 to 639 range. So in this era of big data, there's more and more data available, which hopefully provides the incentives for folks to figure out, how can I boost my credit score? I'm going to skip this slide here. Another question I often get when I'm out on the road is folks want to know about this company called Credit Karma. Those of you not familiar with them, they offer free credit scores. Now, obviously, we can get free credit reports. Those are available from the 3 credit bureaus at annualcreditreport.com. But credit scores until recently cost something. And I say until recently because we've started to see some credit card companies, I think Discover was one of the first, in their monthly statements, they will include credit score for the individual cardholder. But Credit Karma, you go on their website, probably have to provide them, yes, you do have to provide them an email address, and you can get a free credit score, and you're getting weekly updates also. And folks often ask me, how do they make money? So I came across this article actually in the last week from the New York Times, which said they make their money from referral fees. So credit card companies will pay anywhere from $100 to $700 for every customer that signs up for a credit card. Their revenue estimated in 2015, I was kind of gobsmacked by this, $350 million. And they have over 60 million accounts. So just order of magnitude. Another popular financial website many of you may be familiar with, Mint.com, has about 6 million. So these guys are the big kahuna. Obviously, the question many folks have is the conflict. Is there a potential conflict here? Are they providing the best credit card for the customer, or just steering customers where they're getting the highest referral fee? But this kind of lays out for folks Credit Karma. So in terms of teaching tools, I've included a podcast here. John Alzheimer is an incredible interview. I really enjoyed that podcast. He really brings credit scores to life and just knows a ton about the subject, having worked for a couple of the credit bureaus. And then here's some additional teaching tools that you can use. The case study I like because it helps bring to life this concept for students that you can be a really responsible person when it comes to your finances, not taking on any debt, not having a credit card, um, paying with cash, doing things that you consider to be very responsible. But then you can be surprised when you're ready to rent an apartment and the landlord says no because you don't have a credit history. And so that's really one of the key messages in that case study. And then students go out and do research to say, how can I establish a credit score in an alternative way? So investing, shifting gears here. I'm going to talk a little bit about psychology. I'm going to talk about how the tactics of investing are changing. And then I'm going to talk about some of the new alternatives that have seen a lot of growth. So this is kind of interesting. And, you've probably been seeing the headlines recently. We're hitting new highs on each of the indices, Dow Jones, NASDAQ, as well as the S&P 500. And so you see, the drawdown from 2008, I think we were down 60% at one point. So around 700 on the S&P 500, and now we're over 2,100. So you've seen a tripling. And even if you didn't sell, you've seen growth from 1,600 on the S&P. So what happened on the right-hand side is it shows you what percentage of U.S. adults invest in the stock market. You see 2007, that's kind of a peak, 65%. And then you see the sharp decline. So when you touch a hot stove, you pull your hand away. When the market drops 60%, you get the heck out of it. You see a drop to 57, and then you still see the residual effect. So these folks, dropping from 57 to 52%, they have not enjoyed the run up in the market. And so there's an element of psychology, loss aversion. We know people feel losses a lot more than they enjoy gains. And so with young people, so again, that was all adults. With young people, I would just focus your attention on the investing section of this slide. Now, this actually is not in the slides that I sent to you. I'm always looking for new content and discovered this in the time between sending that out to you and finding this. But what I would say here is they say the 87% are confident to make investing decisions on their own. And then you go to circles over and 70% are holding their savings and investments in cash, and they distrust financial markets. And so obviously, particularly for any savings or investing they want to do for retirement, that is a suboptimal strategy. Now, there may be reasons they want to hold their savings in cash. They may be saving for an item and don't want to have it locked up in the market. The typical rule of thumb is if you need the money in 3 to 5 years, then you don't want to be invested in the market because it's extremely unpredictable. But this is a concern when you look at these numbers. And again, the causes of it are probably myriad, hard to pin down, but or they believe investing is too risky. I guess that's the other thing. So the key is this going to lead to a lifetime of behavior where they are underallocated stocks, which over the long run have the highest growth versus cash or savings accounts for that matter. Savings accounts today, you're losing to inflation. And so when we talk about risk, oftentimes people think the risk is the risk of loss. And I would argue risk is really the risk of loss to inflation. And if you want a guaranteed loser in terms of investments, put your money in a savings account earning 1% when inflation is 2 or 3 because you're losing buying power. So in terms of new tactics, passive investing is taking off. So those of you not familiar with passive investing, this means investing in index funds. So you're not investing in a mutual fund with a manager who's trying to beat the market. You're accepting that you're going to earn the market's returns. And you look at the numbers here, it's really accelerated in 2016. So the green bars show you the increase in assets. So how much money is flowing into passive strategies. And I think the most popular passive strategy is investing in the S&P 500. And that's offered by a variety of fund management firms. But you see that really steady growth. And then you're seeing active strategies. And again, that's people who are trying to beat the market, really that's been steady over the last 10 or 11 years. So you wonder, why would that be the case? And I think there's academic studies out there which prove time and time again that if you choose an active strategy, there is a significant probability that you're going to earn less than the market return. So you're betting on a manager beating the market, and this chart shows you how difficult it is. And so I titled this chart, I thought these were experts. Quick anecdote. I joined the money management business. I was at a mutual fund company 20 years ago. And so we were active managers. I was convinced in my role as a research analyst that if I did this, if I focused on this intently, I could pick stocks that outperform the market. First day of work, I pull my mentor aside and I say, hey, I'm signing up for the company 401k. Which investments do you think are the best ones here? I can look at the charts, but I wondered if you had any opinions about the managers. He said, let me give you some advice. He said, I invest with Vanguard and I invest in index funds. That was 20 years ago. So when you look at this chart here, what it's showing you is the height of the bar is the percentage of active managers who beat the market. So over the past year, it's about between 10 and 20%. Over 3 years, it's approaching 10%. At 5 years, it's about 10%. So you got a 1 in 10 chance. If you chose an active manager 5 years ago, there's a 1 in 10 chance you outperform the market. The numbers actually get better when you look over 10, 15, 20 years. But obviously investors are near-term focused and they see, geez, I haven't beaten the market and there's 9 chances out of 10. And the problem with this is that even if you think you can beat the market, it's hard to pick managers ahead of time that are going to beat it. There's not a lot of persistence in these results. And so it's interesting to see now, this was an article I just pulled a day ago from the Wall Street Journal, like the mutual fund industry of active managers is getting nervous. 60 of the largest mutual fund companies got together to say, hey, we got to do something because of persistent client withdrawals. And what's listed here is what's the benefits of index trackers: simplicity, lower fees, and you're going to match the market. And so there's obviously a lot of concern. So I think that's a trend that's going to continue as you think about kind of, well, should I include this in my lesson because it's just something that is a flash in the pan and may not persist? I think this is here to stay. I think another shift we're seeing is around what's called robo-advising. And so those of you not familiar with this, what is robo-advice mean? And so I've listed in this slide the 4 major characteristics: a rich digital UI, that's a user interface. So something that looks really good on a computer screen or on a mobile phone. And then it's pretty simple process. In fact, you can go on to a website like Wealthfront and try it out. They have a personal survey. I think some of them ask 7 questions, some ask 10. They're trying to figure out your risk profile, your age. And then what they're doing is they're creating an automated portfolio for you. So it's basically you answer these 7 or 10 questions and boom, we will give you a portfolio. Now, what they're putting in the portfolio are not individual stocks. They're putting low-cost index funds. So the thought is if you take, low-cost advice, they're basically surveying you and creating a portfolio. You're kind of getting, an allocation. You're getting advice on your allocation at about 0.25% in terms of fees, which is pretty low when you consider an active manager. So if you hired somebody or you bought a mutual fund, you might be paying 80 basis points, 0.8% or 1%. And so really the pitch they're giving is you're getting professional advice in low-cost fees. And so let's take a look at their growth that's expected. So it started slow. There's about $300 billion today, if you look at 2016, in robo-advising, and that's expected to grow to 2.2 trillion. And the reason I think this is a trend that's for real is it started on the fringes. There were a couple of startup companies, Betterment, Wealthfront, Personal Capital come to mind. They, in effect, proved the concept, and now you're seeing folks like Vanguard and Fidelity offer robo-advising services to their clients. And I think ultimately what happens is I think it ends up becoming a hybrid where there is this robo advice, but there'll also be an individual available, a professional available to help you. Because one of the things to keep in mind is robo advising is a relatively new phenomenon. At this point in time, the period of time they've been in existence, the market has been pretty straight in terms of its growth. And the question is, what happens when the market turns down and the investor wants to talk to somebody? And so I think ultimately a hybrid model wins. But I think this growth, a lot of it is tied to millennials because they seem to. Sometimes people wonder whether they do want to talk to anybody or not. But robo advisors have really catered well to that market. Here's just kind of what the output looks like. So I went on Wealthfront and put in some information about myself. And again, it was a personal survey. No, you don't have to provide any identifying information. I think they asked me my age. They asked me what my risk tolerance was. They asked me 5 or 6 questions, and it spits out an asset allocation. And again, not individual stocks, but various indexes from U.S. stocks to foreign stocks, emerging markets. You get a sense of what they're providing here. And I say it half in jest. Is this the future stock market game where instead of picking stocks, we have students create asset allocations? I frankly would like to see it. I'm trying to figure out a way to make it engaging. So stay tuned for that. The other product that seems to be killing it because of its simplicity is something called target date funds. These are held by 60% of 20 somethings. Their appeal is their simplicity. I say that these are the only fund you'll ever need. And so basically what a target date fund is made up of is you choose a fund. So let's say I was going to retire in 40 years. I'd be about 90. I would choose a fund, in most, I think you're seeing most large fund families, Vanguard, Fidelity, T. Rowe Price, offering target date funds. And the way they're listed is by year. So if I was going to retire in 40 years, that would be around 2056. They typically run in 5-year increments. I would buy the target date fund 2055. In that target date fund 2055, there'd be a mix of stock funds and bond funds. And they're typically made up of index funds. And I think there's a nice activity around because we know this is going to be the choice that many students choose when they're old enough to and enrolled in a 401k. There are differences between target date funds, and so you can't just look at the name itself and say, okay, I must be safe, because what's different about them is what the mix is between stocks and bonds. And then what happens with these funds is they automatically change the allocation. So you buy the fund, and what's happening beneath the surface is, you might start when you're 25 in the target date fund 2055. You're going to retire in 40 years. And it might be 90% stocks, 10% bonds. And then maybe every 10, 15 years, they might tweak the portfolio in terms of decreasing the amount of stocks you own, increasing the amount of bonds. And so they're automatically doing that on autopilot. And again, one thing you want to look at with these are fees, because there is huge variance. I think the research I found said an average of 0.78% with as low as 0.17. So here's the growth in target date funds to give you kind of some context here. This is target date funds tend to be in 401k plans. I think 401k plans are about $4 trillion. So they are growing from something that barely existed 10 years ago in 2006. Pretty sharp increases. Here's why people choose them. I think I already discussed kind of this ability to just make one decision, one fund, and the details get taken care of. So provided a lot of resources here on the categories I discussed. So active versus passive investment management. There's a podcast. There's a great simulation which teaches students the simulation, Think You Can Beat the Stock Market, teaches students the benefits of buy and hold. And so we kind of build out a mini activity for you there. This podcast about the $1 million bet is captivating because Warren Buffett made a bet with a hedge fund manager that index funds would outperform some of the brightest minds in the hedge fund world. And so far, I think the bet was made in 2006. And I think right now, the index fund over the last 10 years has vastly outperformed hedge funds, which are generally considered the sharpest minds in investment management. So that's investing. So I'm going to do a quick time check here, and I'm really going to have to hustle here, but hopefully I hit those two areas that you were most concerned about, which was paying for college and investing. So identity theft, you know, you've seen the names. I often wonder whether we should just assume at this point anything we put online is going to become public, because that seems to be the way the world is going. So these are all major companies that have been hacked within the last year or two. Three major types of attacks going on here. Skimming, which we're seeing more and more of. This is when they actually place a card reading device over the existing one. These are particularly popular at gas stations. And so when you stick your card in, they're extracting all the information, and then they're able to, they've got all this credit card information with the codes. Ransomware is relatively new. That's where they put they're able to lock up your computer. So they plant a virus, and next time you log on to your computer, you get a screen that looks like this. And then they ask you to pay, typically in Bitcoin, in order to get your data or to unlock your computer. And obviously, sometimes you pay and don't get access to it. Phishing is, this idea. I think it started with like a prince from Nigeria who was looking to move millions of dollars to the U.S. and just needed somewhere to house that money. And can you provide bank account information? So these typically come in email form. They may be trying to get you to click on something so they can put some malware on your computer. But these are all some examples. We've got some great teaching tools there, including a new lesson. We've really built out what we have on identity theft, so you may want to take a look at that. Because this is constantly changing, I think the tactics are constantly changing as well as the frequency of them. We've created a web quest where students go out and figure out what the latest schemes are, as well as ways to protect their identity. Careers, I don't need to tell anybody on the call today about the dramatic change in careers. The term gig economy, you think about companies like Uber, Airbnb. There's a lot of folks. I'm seeing the word side hustle come up more and more, where people kind of piecing together. They may have a full-time job and do other things on the side in addition to that, or they may cobble together a full-time job from different freelancing opportunities. I'm going to talk a little bit about how people are getting jobs today, and then how the pace of automation all around us is putting millions of low-skill jobs at risk. So I was surprised at the number here that 50 million entered the gig economy workforce in 2015. So there's 50 million, and they're calling them micro entrepreneurs. So who are they? Here's just some of the areas that these on-demand businesses are attacking: transportation, delivery and logistics, events, home services, health and beauty. There's obviously a lot of freelancing sites too, where if you have a specific skill in graphic design or editing, there's a company called Upwork, which I think is a multi-billion-dollar company, and that's where freelancers go. So these are just some examples. In terms of where people get jobs, and the reason I bring this up is I think the importance, if you're going to include careers in your curriculum, the importance of showing students how to network. And basically, the red bar here shows you how people get jobs. So if you're underemployed or unemployed, 47% of people are getting it through networking, actually more than through just applying. And so if you're applying for jobs, you're really at a huge disadvantage. And you see how, that actually gets even stronger. The importance of networking for these other categories. The categories on the bottom show just varying degrees of employment. So in terms of automation, I see it in my neighborhood. We get these Google cars running around, these autonomous vehicles. Obviously, that's going to displace a lot of driving positions. We now have autonomous trucks, a company called Otto, I believe it was just acquired by, may have just been acquired by Google or another large company. So there's about 3 million truck driving jobs in the US. And so those sorts of positions are under siege. In terms of retail, Amazon just announced a format for groceries, which don't have checkout counters. When we go to fast food restaurants today at McDonald's, you don't see, they're starting to put more touch screens in for ordering. And then on the upper right, you see that's the financial advisor. So I talked about robo advising earlier, and that's clearly a risk to the financial advisory business. And so all around us, from transportation to retail to financial, we're seeing more and more jobs um, be automated. So we have a new lesson on entrepreneurship. I'm coming to the belief more and more that a large percentage of people are going to have to find or create their own jobs, and entrepreneurship is a great skill, uh, great thing to expose students to. We also have a lesson on networking and informational interview because we saw how important that was. So I'm going to. I realize the hour is up. I'm going to take a minute before moving on, just to see any questions that folks might have. And I apologize if I've been talking too quickly. So if you have a question, okay, I'm going to keep going then. And I think I've got about 10 or 15 minutes for those of you trying to plan how much longer we're going to go. And I appreciate you staying on the line. The next section is how teens shop. And I guess, if you want to look at an interesting blog post, I did one, was it earlier this week, comparing where financial services were in 2001 versus where they are today. And I guess we often lose sight, because change is incremental, of kind of where we were pre-iPhone, early internet days, and just thinking about how much the world has changed. That was a really useful blog post for me to do, because it did force me to take more of a longer term longitudinal view to say, boy, things have really changed. So when you think about the nature of shopping, I'm going to talk about where we shop and how we shop has changed. There was an article recently, and I don't know, whether to place much credence in it, but it was about anti-consumerism, and so I probably leave it up to you based on what you're seeing in your classroom as to whether that's really happening. And then the other point I would make is, given how shopping has changed, I think we need to do more around the behavioral side of figuring out how we can change behaviors within the class. So I'm going to talk more about that. So in terms of shopping trends, great chart here from the Wall Street Journal. And what it's telling us, it basically surveyed people who had made at least 2 online purchases in a 3-month period. And it found those people who are making online purchases are now making more online than they are in stores. So we've kind of crossed the threshold here. That's the bar on the left-hand side. You see in the middle chart here the various approaches that people take. So on the right-hand side, if you're looking at the center, the pie chart, you see those basically 58% buy online. Some just search and then go ahead and buy. Others research online and in the store and then buy online. And then you see people who research online and in store and buy in the store, and then 20% search and buy in the store. I'm really happy that I'm an online shopper this time of the year, because the long lines you see everywhere. But just interesting to see how people make purchases and how they leverage online research. Because if you look, basically everybody's doing, I guess 80% of folks, based on the middle chart, are doing stuff online versus people who just go into a store and buy. So a lot of prep work or a lot of completed transactions occurring online. And then the chart on the right-hand side shows almost 2/3 of millennials are purchasing items on a smartphone. And I would not be surprised to discover that the teens in your class are even higher than that. It's actually interesting to see how dramatically different it is between generations too. Um, this is a fascinating chart. So this is kind of where we shop. And so what it's looking at is it's comparing, this is a 10-year period. So this is obviously a longer term trend. On the left-hand side, you see the market value. So what's the market capitalization, the stock market capitalization of each of these companies in 2006, and what is it today? And so you see basically every retailer, with the exception of Walmart, is worth less. So that's the stock market value, the number of shares times the stock price. Some of them pretty dramatically. J.C. Penney, whose turnaround failed, they're down 83%. Sears, I'll never forget this time of the year. Okay, I'm aging myself here. The Sears catalog, to see their fall from grace, they're down 95%. Even Popular, Target, down 15%. This is over a decade in terms of what the value of the company is worth. And then at the very bottom, you see basically Amazon up 1,900%. It's basically worth more than all these other major retailers combined. And so if you need any more proof that until they built this grocery concept, which is very early in its infancy, all of their sales are online. So you get an idea as to where the growth is. How we shop, again, no surprise that the fastest growth when it comes to online sales is coming from mobile phones. That's the red bar here. And so you see the growth rates by quarter, pretty dramatic. I mean, you're talking 60. Now it's obviously a lower base of people who are purchasing, so it's a lower starting number, but 50, 60, 70% growth rates on mobile versus desktop. So that creates a set of challenges, I think, that we need to address, which is this ability to buy anything anywhere. And retailers are succeeding at training customers to think of their smartphones like an all-day impulse aisle. They push consumers to buy when they have a spare moment. They create an impulsive buying moment at any point in the day because they are with you all the time right in your pocket. And so we're going to create more. I think you're going to see more content, more lessons, more activities come out around this issue of impulse, because I think it's a huge issue just given how easy it is to shop now. So here's this article I was talking about again. I don't know whether an article makes a trend, but it talked about students being more price sensitive, students skipping traditional retailers. And then this was the most fascinating one. I don't know who Cassandra is. Maybe, but the survey conducted by Cassandra, they found 77% of respondents said culture has become too consumerist. 89% said reducing consumption will help make the world a better place. I'd just be interested if folks want to share kind of, you can just shoot me an email afterwards at tim@nextgenpersonalfinance.org if that jives with kind of what you're seeing in the classroom. You want more evidence of probably consumerism as well as growth in online shopping. This just yesterday from the Wall Street Journal. UPS and FedEx struggle to keep up with the surge in holiday orders. So when you're ordering online, be sure you probably want to get that done ahead of time. So what we currently have around this issue of impulse control and delayed gratification, many of you are familiar with this video, Don't Eat the Marshmallow. It looks at a study of 5-year-olds and really gets at this issue of delayed gratification. The second resource I have listed there's a New York Times columnist, Carl Richards. He has a column, Personal Finance Truths on a Napkin. And one that I recently came across was this idea of all purchases being subject to a 7-day moratorium. And I really feel like you have to have some sort of habit in place, or you have to have a strategy in place in order to control your impulses. There's great video here from PBS NewsHour about why teens crave what's cool. I think that's a great starting off point for a discussion. And then Elizabeth Justema from a Summit High School in Bend, Oregon, she shared with us her lesson on what are your money values, because I think that's something else that needs to be discussed as shopping gets easier and easier to do, making sure folks are taking a deep breath, stepping back, and figuring out where they're spending the money, whether it's in the right place. Moving along here, fintech. I've talked a lot about innovation. And this is a market map of all of the financial technology startups that are targeting millennials. Some of these companies you're probably familiar with. Some of them, your logos, you're probably not. So the question always comes, how can I keep up with this? And my response back would be, you don't have to. Let your students. So we have a great project, Online Tools, which basically provides students with a list of companies that they could choose. These are startups, many of them listed on this page here, and then a list of questions and asks them to be an app reviewer. So let them go online. Let them become app reviewers, because ultimately I think that's a skill. These products are going to continue to change, but their ability to ask questions like, what's the business model? What's the potential conflict of interest? What are the fees that are associated with this? What's the potential catch? Just basic questions, creating that mindset, into that critical thinking mindset. And I think this is a great way to do it. And it's also, you can give them different ways to present their findings, their results, and it's a great way for you to keep up to date also on what's happening with fintech startups. So this is just another list of, I pulled this from PC Magazine, listing, what some of the favorite apps are today, some of which I'm familiar with, others not so much. But you could even have your students use this as a skeleton for their analysis of apps. So again, our teaching tools, I think the best one is this becoming a mobile app expert. So again, it's not dependent on a specific set of apps. You can have students choose their own, or we have a list within this activity that we keep updated. If you're really interested in financial innovation, I had a couple of great investors, Colleen Poynton and Alex Davidoff of Core Innovation Partners, strictly talking about what trends they're seeing in financial technology. Regarding taxes, just wanted to put this on the radar screen. This is the proposal coming out of the new administration. And so we just have this on our radar screen because, as I'm sure you're aware, we update our materials, we update lessons, we update our activities as new information comes through. And so I just wanted to lay out for folks what the proposal is, as well as a link if you want to learn more about the tax plan with the new administration. Regarding healthcare, actually, when I was on my way into work today, it sounds like there's 3 or 4 different options. I don't even beg to anybody who can predict which direction that's going to go, from repeal and replace to repeal and delay to repeal and I think there was a third one that I've been reading about. So we're going to hold off on that until there's definitive legislation. But again, we will be sure to update our healthcare lesson within our budgeting unit. I wanted to leave you with a couple of those of you who either read the blog or interested in learning more about it. I thought I would just give you a list of kind of what's the hottest posts are on the blog. And so I've just listed the top 5 overall, which you'll see here. So you'll see the topics are budgeting, credit scores, student loans, budgeting, and paying for college. Those tend to be the most popular. And then for new posts that we've done this year, if you haven't played the game Spent, which is the number 1 on the list for 2016, it's a great simulation to help your students learn and actually experience what it means to live paycheck to paycheck. You'll also see this opening a bank account, the power of role play that I had discussed earlier when we were talking about cross-selling. Uh, Finally, I just want to let you know what's coming down the pike from NGPF, what you can expect to see from us. We're going to spend a lot of time repackaging what we already have when it comes to curriculum. So we've heard feedback from teachers who want to use us as a core curriculum. They'd love to know scope and sequence for a semester long course. So we're going to take what we have and create that. We've also heard folks wanting different time increments. So whether it's I have 1 week, I'm an econ teacher and I have 1 week devoted to financial literacy, what should I include? We'll be repackaging it into varying time lengths so that you can just pull something right off the shelf and use it in the classroom and have the scope and sequence for the amount of time that you have available. We're going to be revamping our website, making it even more user friendly. So imagine, I'm real excited about the mock-ups. Jessica has been working with our developer on this. I'm real excited. So for example, you'll click on, you're interested in checking, and on one screen, you'll get the variety of resources that we currently offer. So rather than go to separate screens for the data crunches, the questions of the day, or the fine prints, if you're looking for checking, you'll have lessons, projects, activities, data crunch. It'll all be on one page. So I think that, and we're also going to include, and I'm embarrassed to say we don't have it yet, we're going to have a search bar also, because as the content has increased, you can currently search on the blog, but you can't search outside of the blog. So we're gonna fix that. And you'll probably see something in the first few months of 2017. Due to the popularity of the Summer Institute, we're going to run it twice this year. So we'll be doubling the number of participants. Those of you not familiar with the Summer Institute, we did it for the first time last summer. We invite 12 teachers. So we have an application process. We selected 12 and we had a 2.5-day workshop in Palo Alto, California, all expenses paid. We learned a ton through that experience, and we got some tremendous feedback from teachers, the teachers who attended also. So we want to do that twice. Additionally, on the PD side, we want to do regional boot camps. So you may hear about events that we're putting on in your neighborhood. So if you are extremely excited and interested in having us come to your area, and you will help us find 20 to 30 teachers to put on a workshop, we are all ears and would love to do it. We're also going to be adding Spanish language projects and activities to our to what we currently offer. So, and I put and more because we're all ears. And so I often think the folks who participate in our webinars are some of the most committed teachers, educators interested in really perfecting their craft. And so please let us know if there's anything we can do to support your work in the classroom, because that's what we're here for, and that's where our best ideas come from. So I've kept you 16 minutes late. Many of you may be familiar with these useful links already, but I'm going to take a breath here, maybe a drink of water, and I'll see if you have any final questions before we go. So there was a question about the slide where I had the different types of purchases and the category other. I'm going to have to take a look. I don't have that information handy, so I'll take a look at that. So I think that's all the questions we have. I want to thank you again for participating in this webinar, and I wish all of you a happy holiday and a happy new year. And thank you again for all the work you do in the classroom every day to deliver these skills, which are just so important, that your students are walking out into beyond high school knowing how to navigate the world of money. So we're honored to serve you. Thank you.